Jamaica is a highly prospective target area for different kinds of deposits in an island arc terrain.
As probably the most widespread, intensive, and in-depth exploration program that's ever been carried out in this island.
5 or 6 years worth of work into just 2.
No one else has ever done this before. There has been historic work on the island, trending back 150 years.
I think they're getting excited, as we are, so stay tuned.
Hello, everybody. Welcome to another Minds and Money online session. As ever, it's a pleasure to be here. I'm Graham Dallas from the London office of the Toronto Stock Exchange and the TSX Venture Exchange. And we've got a panel here to talk about M&A activity over the next 18 months, how it's going to be different from what we saw over the last unusual year. We've got a great panel. Ross Bappu, who's head of private equity funds at Resource Capital, Caroline Donnelly, who is now a managing partner at Sprott Resource Streaming and Royalty. Some people may know her from elsewhere. David Street from Tembo Capital, an old friend, and Mike Barton from Orion Resource Partners. So I'm going to kick things off by talking just a little bit about what did happen in 2020. According to Standard & Poor's, mining M&A was down by about a third in 2020 from 2019, which I think is an outstanding result, really, given that 2020 was so horribly impacted by the virus, at least at the beginning, and in so many real world ways. And also the fact that 2019 was kind of a big year. There were a couple of very big deals with Barrick and Randgold and Newmont and Goldcorp, which would have boosted the overall figure. So according to Standard & Poor's, there were 61 mining M&A transactions in 2020 for an aggregate value of $16.7 billion. So it was down, but it was by no means out. And as I say, considering the start to the year, maybe not such a bad result. So I guess the question really is, did everything happen that could have happened or should have happened, or was M&A held back in any way during 2020? I'm going to just sort of ask people to speak in the order I've got you on my screen, so I hope that's okay. Caroline, can I ask you to start? What do you think? Was it held back in 2020?
Absolutely. Well, good morning, good afternoon, everybody. I think for 2020, many people and many companies spent their time trying to figure out how to do due diligence. And that seemed to be a recurring theme coming up in M&A transactions was, how do you get to site? How do you make sure you have the right people at site? How do you find the right people? And, I think for countries that have large pools of mining skills and experience, it's obviously much easier for companies which aren't in that country to do due diligence using the internal people. I think for places that have a much smaller mining skills base, that makes it very challenging, because how do you get into the country? Are you going to spend 14 days quarantined in a hotel on the assumption that you even want to travel in the first place? So, my sense with 2020 was a number of those deals which happened had been started previously, where people had already been to site, they'd already got some comfort around the asset, they'd perhaps met the management team. And so those were able to continue. I think what we've seen is, as we've headed towards the end of the year, and what I expect going into this year, is that people are getting more comfort in how they go about their due diligence, and the fact that, those of us who you see on the screen who would ordinarily go to site may not necessarily have an opportunity to do so. So I think the comfort levels are improving, which to me bodes well for M&A this year.
Interesting. David, you're up next on my screen. What's your view on
Thanks.
Year behind or the year ahead, or the 18 months ahead?
Yeah, no, thanks, Graham. Look, I agree with what Caroline's just said. I think to begin the year, last year, we had a few transactions which clearly had been in the works for a while. I think Endeavour bought Teranga, for example, one or two other transactions like that. And then I think you probably had a hiatus where people worked out how they were going to assess things, do due diligence, etc. Probably a slowing down in the middle of the year. And then by the end of the year, you've got the realization from all sorts of organizations, including people like ourselves, that you need to find a way to work around these things and do virtual visits, due diligence as much as you can. And I think you've seen transactions as Caroline said, which are in jurisdictions where people are more comfortable, perhaps seeing transactions like GT Gold announced just today. They're being bought by Newmont. Obviously, Newmont knew the asset well. Previously, they were already a shareholder. So I think those sorts of things where people are familiar with what they're doing prior, those will carry on. And as the world opens up, I think, particularly on the gold side, but across other metals as well, I think we'll see renewed activity later in the year. I think the market's in a much better place than it was in 2019, the last sort of normal year.
Yeah, good. Mike, would you build on that? Anything to add to that?
Yeah, I mean, I totally agree with the comments that have been made so far. Of course, I would probably comment that I think, you know, the mining industry is a small industry, and there is a high degree of familiarity with assets. So often, I don't think people necessarily needed to do that, you know, on-site due diligence, because half of the people have already been to mines. So I think it was both the you know, where deals had been in the pipeline, or where people felt they could do a deal with an asset they were already familiar with, even if that only started during the year. But I think the other thing that constrained things in 2020 was the commodity prices. It's very difficult to do M&A when you've got moving commodity prices, because your buyer and seller often have different views on where those prices are going to settle. So I certainly think due diligence or familiarity, if you will, was a factor, but also where were you going to pick the gold price? And I think that's why you saw an awful lot, those M&A deals that did happen, you know, the sort of, the most common deal, if you will, or the theme for 2020 of the deals that did happen were nil premium mergers.
Yeah.
You know, so that's a function of no one really knowing where the gold price is going to be. So let's do a nil premium merger. Yeah. So I think that's another emerging theme. And I think you've got the same challenge, if you will, now going into 2021 on the base metals, and gold perhaps for different reasons. So I still think the outlook is a bit tricky in a sense, in that no one's quite sure where things are going to bottom just at the moment.
Mm. Ross, we're relying on you to come up with something completely different rather than agree with everybody else. But if you do, that's fine.
No, look, first of all, I do agree that it was a difficult year to do due diligence. And I think that challenged all of us that are in the deal-making business. But what I found interesting is when you look at deals announced by month, May, for example, was a pretty strong month for M&A transactions. I think people were shell-shocked sort of at the beginning of the year. They were unwilling to commit to deals, and they sort of got kind of comfortable that COVID was going to be here to stay for a while. And so they pulled the trigger on a number of those M&A transactions. And then you move forward to October, November, December, so Q4, and there were a very large number of deals committed in those, especially October. And again, I think people started to get comfortable that they could do due diligence virtually. They were getting comfortable with projects and deals that they already knew. And so, you know, we saw a big increase in deals in Q4. And look, I think it's continued into the first 2 months of this year. You know, you look at, well, to back up, our commodities economist internally at RCF said, you know, this year, 2021 is off to a ripper. And in plain English terms, I took that to mean it's going really strong. And when he sent me a list of what's happening out there, it is actually amazingly strong as a start of the year. So yeah, I think people are starting to get comfortable, and I think due diligence is, people are figuring out how to do it, and I think that's a critical aspect.
Yeah, it's interesting though, isn't it? I mean, a lot of people have said a lot of transactions were kind of being thought about, or maybe were in the pipeline already, and obviously it takes a little while to close a deal. I just wonder if is it going to be possible to sort of refill the pipeline with new transactions, given the constraints on travel, but maybe given that people.
I think, Graham, there's been an awful lot of tire kicking in 2020.
Right.
You know, there's an awful lot of, you know, the BD teams of most mining companies have been sitting at home, not doing very much. So what have they done? They've entered 1,000 data rooms and looked at 1,000 different projects. So the sort of the top end, if you will, of one's deal pipeline for most businesses is pretty full. They've not been able to perhaps advance that pipeline in the way you might normally do, and you know, and filter it down to the deals they're actually going to do. But I would have said most mining companies have almost have a renewed sense of what's out there, having spent a year looking at assets. If I think about a number of assets in our portfolio, the number of calls we've had inbound saying, "Oh, could we look at this and refresh where you are with that asset?" Has been like nothing before. It's mainly been BD teams. It's not been the CEOs calling, if you will. It's not been the CEOs calling saying, "We want to do this deal now." It's been the BD teams saying, "We want to make sure, because we've not much else to do. We can't travel. We can't go to this conference, that conference. Let's have a look what's out there."
Right. So they want to know as much as they possibly can, given the constraints of the times we live in.
Which suggests, though, that if the climate allows, some of those deals will come to maturity.
Right. Lots of fingers on lots of triggers, potentially.
Yeah, and I think to Mike's earlier point, the increase in commodity prices certainly helps people feel better about acquisitions and mergers. Whether it should make them feel better is another question entirely. In the mining industry, we have this history of wanting to go out and buy all the assets while prices are high. It doesn't necessarily work out too well for people, but certainly that's the mindset is prices are running, therefore we need to acquire things and we need to acquire them now. And that's quite unfortunate in the sector, because really, if we were thinking clearly, we all should have been buying assets, March, April last year, because then we would have seen fantastic pickup in value. But it's hard, I think, to try and balance that wanting to acquire assets without looking like an idiot because the prices are so low and it looks like your assets are never going to make any money, versus wanting to acquire assets when the prices are high, when it looks like you're going to make a ton of money, but you could look like an idiot in 2 years' time when the prices are high. A tough balance, that one.
Human nature. That would have been a very, very, very brave call to go out, buying large in the spring or Northern Hemisphere spring last year, when it kind of looked like the world was going to go end at one point, let alone what's going to happen to particular commodity markets.
I think Caroline's point, though, that's the reason you've seen a lot of stock deals rather than cash deals. Yeah. I think that's exactly the reason that, even if you're paying a premium in stock, it's very different than paying cash. For cash bids, most mining, let's take gold. Gold was obviously doing great, but no one that I was talking to was offering cash at those sorts of spot gold prices. But many of the sellers or theoretical sellers were sticking the spot price into their models and assuming that that's what they would be selling for. So particularly some of the junior gold companies, they really overran where any credible senior or mid-tier acquirer was ever going to pay in cash.
Right. And that, which obviously puts a constraint on the M&A that we're talking about, but perhaps not a bad problem to have if you're that particular junior and you use it as an opportunity to raise some money in other ways. What about, sorry?
I was just going to say, I wonder if some of the sellers actually preferred taking stock, getting further upside if they saw opportunities where the stock was going to be accretive. So, I wonder if it was a two-way street there.
I think, Ross, a couple of sellers I was talking to, and you'll know the same companies, they've not really hidden the fact that they're theoretical sellers. I think some of them were disappointed their stock had run too far, actually, in some instances, because that deal that they had planned and almost had said, I'll sell at this price, I'll wait till I get it. They blasted through that price, and then there was no bidders out there, even in stock. I know a couple of Canadian companies who found themselves in that dilemma.
Right.
Oh, interesting. What about sectors? Are there particular subsectors? Is it one of the things that seemed to happen in general news during last year was that electric vehicles got really lots more attention, I guess partly because of what was happening specifically with Tesla, which was interesting, but also what was happening in the real world where big car companies started to deliver far more automobiles, Mercedes, BMW, Volkswagen, etc. So it did seem that the whole electric vehicle thing, which clearly was a phenomenon anyway, really gathered momentum during 2020. Will that feed through specifically into battery metals? I mean, copper's what's copper, $9,000 a ton or something, isn't it, or thereabouts? But will it feed through? Is there going to be a lot of attention on copper, do you think, specifically, given that there's a shortage of large assets, or will it be other battery type metals? Our old friend lithium is one of the underperforming mineral prices, isn't it? But then there's things like the rare earth metals. Is that whole electric vehicle and electrification and green energy theme going to drive a particular set of transactions, do we think?
Yeah. You know, I think on the copper side, this has been a sector that people have been looking at for a long time, saying grades are declining, costs are increasing, we need more copper, we need more copper. So to me, the copper story is really just a continuation of the, you know, kind of call it pre-COVID times, when everybody was looking around. The challenge you had pre-COVID was, of course, prices were relatively low. And let's face it, copper going down to $2.20 a pound didn't help anybody as they were thinking about making an investment decision. You know, I think now we're on the flip side and going, you know, to Mike's point of perhaps prices might have run too far. You know, I think for certainly developers, it's an easier market, if there's such a thing, in order to develop a copper asset. I think the challenge you face is that the people that provide finance, including some of us around this table, are not plugging the spot price into the model. You know, we're not looking at financing these assets at $4 copper. So this, you know, again, it's that whole balance thing, I think, comes back into it. But certainly to me, the copper story is just a continuation. And look, it really helps that the bankers have come out and said, oh, it's a super cycle, and, you know, copper's going through the roof, and we're back in our next 14-year super cycle. You know, I think that all looks very promising certainly for the copper space.
I think, Graham, it's somewhat bifurcated. I think the larger companies clearly are likely to be interested in bolting on copper assets, nickel assets. Some of the deeper markets, there aren't really a big pipeline of copper assets waiting to be put into production, not quality ones. And I think those assets are likely to be in demand over the next sort of period of time, particularly if we can stay with the sorts of copper prices we have today and have a period of price stability. I think some of the more niche markets, lithium, graphite, cobalt, things like this, they're not really of a scale, those sorts of businesses, to be interesting to a major mining company. It just doesn't sort of move the needle for a big diversified miner to own a lithium mine. It's a relatively small business. And I think what you'll see in those markets is more like some of the deals you've seen from the Chinese end users are buying a stake in lithium mine X to secure offtake and product rights and that kind of thing. And I think you'll see that, you know, certainly we've seen it a lot from the Chinese and other end users. You might see that from some of the car manufacturers as well going forward, potentially offtake kind of linked transactions.
So potentially a new class of buyer, owner of these assets.
Yeah, I think so. I mean, you saw that in the 80s and 90s. It was very common for the Japanese trading houses would buy stakes in copper mines, for example. I think that's probably the way forward for lithium and some of these other raw materials. Yeah.
Mike, have you got anything that you'd like to say on the subject of the electrification of society theme?
I mean, it's certainly a real trend, but I tend to agree with Caroline that the challenge is the one I flagged earlier. It's difficult to do deals in a volatile copper price environment, for example, and nickel for that matter. So when the prices have appreciated rapidly, there's a couple of deals that I'm aware of that they've basically stalled because of the fact that the prices run too hard from when they were, when the handshake took place, whether they were announced or not announced, the prices run too hard, and it's impossible for people to transact at those levels. So to David's point, either we need some stability to allow those deals to rematerialize or take place, or we just need a prolonged period of decent prices. They don't need to be as high as they are now to justify that consolidation. On the other hand, there's not going to be that much in a sense because there's not that much out there. So it's not like there's 100. It's not like gold. There's not 100 copper projects or nickel projects for mid-tier company X to bolt on, and then there's not that many mid-tier companies for the majors to sweep up. So there's a limited sort of universe of potential M&A. So you are going to get down to more like your going into your minor battery metals, your lithiums and the like. I'm sure there'll be the odd deal there, but when you quote your stats at the beginning of this, they're not really going to shift the needle in global M&A in mining, because they're going to be the odd deal here, the odd deal there, probably done at very good valuations, but it's not going to necessarily shift the needle.
Yeah, fair enough.
I think that the other big issue is just the uncertainty around the market, the lack of ability to really project prices going forward. I'd look at nickel projects and, love nickel, but gosh, there's these overhangs hanging in the market in nickel that, really make you wonder, what are the Indonesians going to do? What are the Chinese going to do? How's nickel pig iron going to impact, on the battery side? So we get nervous when I look at lithium, for example. We've gotten very hot and cold over time on lithium, and you look at the big corrections that took place in 2019. Another correction late last year. I think there are opportunities and times to get into it, but back to Mike's point, we're struggling to find quality assets to invest in, and the quality assets tend to be highly well priced, or properly priced, so difficult to justify. So it's a challenging place to play, but no question the EV market's here to stay. Demand for those minerals are going to be strong for the foreseeable future. So figuring out how to play it, I think, is a real challenge for all of us on this call.
Yeah.
I wonder if you need a bit more development first in the base metals in particular. So you need to see a cycle of new assets being discovered, developed, enhanced, to enable that to really feed into deal flow for people to sweep up. Because let's be honest, not only are there not that many assets out there, most of the assets in the base metals are well known. People have already run there. They're the same ones from the tail end of the last cycle. They're not new things, and not many of them have radically changed. So I wonder whether or not you need a wave of development first, a wave of exploration and development spend.
Yes. Well, perhaps one of the upsides of the current high prices is that will enable that to take place, to get funded, so that the sort of book of potential target acquisition targets next time round can be built up a little bit on the back of the strength of the commodity prices now. One of the things, sorry,
Graham, certainly anecdotally, if you get those news consolidators from the mining business every day, going back to like 2009, there were maybe 5 or 6 little headlines on those emails. Now you get those emails and you scroll down and you scroll down and you scroll down, and there's 30 or 40 headlines a day. Well, companies are raising money, and junior companies are raising a lot of money.
Oh yeah.
And you see, it might not be a lot in absolute, but $10 million here, $5 million there, $20 million there. There's a ton of activity going on.
There is.
I think what needs to happen, and sort of tagging on to Mike's point, is those companies need to actually use that money to do something that's valuable, not wash it down the drain on G&A. Actually go out and develop their projects. Yeah. And I guess I'm hopeful that quite a lot of that money will end up being plowed into projects, which can then lead to M&A further down the track as those projects get more developed. And hopefully there are some, new and interesting ones that can spark someone's attention.
Yeah, no, you're right. I mean, we see it probably virtually more than anyone else at the TSX. Last year, I think the mining companies listed on TSX and the venture raised $7.6 billion, which it's not the best year ever, but given that like the second quarter was basically dead and there was a lot of uncertainty, it was FUD around in the market. I thought it was an outstanding result. One thing I wondered whether people got a view on, there seems to have been a bit of a uptick in additional listing or cross-border listing or secondary listing, whatever you want to call it. There's people like Newcrest, who obviously listed in Australia. They added a Toronto listing. Yamana Gold and Wheaton, who are listed in Toronto, added a London listing. Is that a precursor, do you think, to sort of big international M&A where a company would like to have their paper more acceptable in a different international market, or is it more just about our old friend trying to tap into more liquidity? Do you think this is a precursor to some sort of cross-border M&A paid for by international listed stock? Anyone is that a thing that's going to happen, or is it are there other drivers for this?
I kind of think it's driven by searching for liquidity. I don't think they're doing it to help them do M&A. You look at so many of the Australian gold stocks last year were trading at such a great premium that they had this great currency to go off and do deals. And I don't think they were chasing a Toronto listing to help their M&A activity. I think those that are trying to do it are simply doing it for liquidity. In my mind, I don't know if others feel differently.
Yeah, I agree with that, Ross. I think that's right. I think there is a drive from some companies to merge and just grow, just the desire to be bigger and to be more relevant to non-mining investors. I think is often used as a valid reason to merge a couple of companies together. Yeah. So just for the want of a bigger scale and to become more relevant, really. But I think the moving to different exchanges is more around liquidity and adding on other marginal investors, really.
Mm-hmm.
Yeah, and I think it all ties into getting exposure through different brokers, trying to bring in more research, getting the investment bankers out there talking about your company. And if you've got a listing which really taps into, call it a new network for the company of investment bankers, research analysts, etc. I think that's to the liquidity.
Yeah, fair enough. I just wonder whether it was perhaps some sort of part of some master plan to increase their M&A firepower in some way. But
it's arguably a hindrance for M&A because you've got to deal with two exchanges. Certainly, if you're trying to buy something and it's listed in, London and Toronto, for example. Yes, usually one will take precedent, but if it's predominantly London listing, you've got to then deal with all of the pain of trying to get delisted in Toronto and so on and so forth. It doesn't help M&A from an acquiring perspective, but I don't think it's defensive. Equally, it would be a very obscure defensive move. So I don't think it's that, but yeah, it's not particularly helpful from an M&A perspective, I would say.
Okay, fair enough. What about JVs? Are we expecting to see an increase in sort of significant joint ventures across the market? And if so, are there particular areas where you think that might happen? So rather than straight acquisitions, more partnerships in projects or partnerships in development and production. Is that something that we're going to see more of? Are companies going to team up to work together, or not?
I think there's been a fair bit of talk about that.
Yes.
I'd say, I think back at Cardinal, for example, developing that massive project in Ghana, they, one time they talked about joint venturing it, but then I think the market realized that that's better just taken over and run by a larger company. And I think there's lots of examples like that where, there's discussion around joint ventures, but at the end of the day, it makes sense for it to be acquired, these assets to be acquired and run by a more senior company. So, yeah, I guess it's horses for courses, but I tend to think that joint ventures, you'll see one-offs here and there, but for the most part, I think these companies will enter into M&A activity and get reduced down.
Yeah, so not really a trend there, you don't think?
Yeah, look, I wait to be seen, but that's kind of my take on it.
Yeah. I think aside from what David mentioned earlier, with perhaps some a Chinese buyer X taking a cornerstone piece of lithium company Y, I would tend to, other than those sort of more specific opportunities where maybe China is not going to go outright and buy an asset anymore. It's going to take that old Japanese or Korean even model, perhaps, but let's call it two TSX companies cooperating to develop one asset. I don't necessarily see happening regularly.
Interesting what you say about the Chinese countries, because of course it was Shandong Gold, wasn't it, who tried to buy TMAC, and well, they weren't allowed to. Another buyer stepped up, but I wonder whether that's...
I think that might be one of the motivations as well, of course, for Chinese companies going and doing it in JV, because in some jurisdictions, and not just in Australia and Canada as well, there's certain, whether or not this proves to be the case, but a number of African countries are behind the scenes suggesting that they don't necessarily want their whole industry being offshored, if you will, to Chinese owners. Right. So even on those assets, I think you can see that trend.
Right. So perhaps something more like a significant minority shareholding kind of thing, rather than either a JV or an acquisition.
Yeah, and it's worked quite well on, say, Ivanhoe, with Kamoa, so that's a good example there that's seems to have been developed very well.
Yes. Yeah.
Be very interesting to see whether any of the sort of Western car manufacturers, end users of some of these products, move in the same direction to secure sort of ESG compliant supply chains of different products. It'll be very interesting to see whether they.
Yes.
At the moment, that's very much a sort of offtake phenomenon.
Yeah.
I see it, but I think it could well be that they start to take percentages in projects or companies in order to sort of secure that offtake.
And there was talk of that in the last super cycle, of course, but they weren't fast enough to move. So they navel gazed for so long that then the cycle was over by the time there was anything to actually do. So maybe to David's point, they're ready to move this time. And, with some new entrants, say in the auto sector like Tesla, maybe they're going to realize that they need to do something to improve that competitiveness faster. And
maybe there's more of a geopolitical imperative this time around, for European car manufacturers, for example.
Yeah, and of course the competition, again from China, I can't remember the numbers, but there are literally hundreds of electric vehicle builders in China compared to a handful in the West. So I guess the competition for that, to get that supply, whether you're focused on the ESG aspects of it or just the sheer availability of it, the competition is going to be potentially quite fierce.
Yeah.
Interesting.
Yeah, I mean, I think we started to see some of that, but through the traders, in the, call it mid-2000s, where traders wanted offtakes, which they'd back to back with an OEM or somebody like that. They were putting equity into companies. So, now I think the traders can get away with doing a prepayment financing or something like that in order to get the offtake. Going back 12, 13, 14 years now, there it was a case of you actually had, those traders were putting in cash. They were putting in equity rather than the debt they're doing today. So maybe we'll see that, but without the traders' involvement.
I think we've got about 5 minutes left. So if there's any specific things that people would like to draw attention to that they think we should be looking out for, that they think is going to happen or is going to stop happening, this is your chance to make your closing speech, really. I think we've got exactly 4 minutes left now. So I'll shut up. So Caroline, I'll start with you. Would you like to sum up what we've said?
Ross, you want to go ahead? Looked like you were about to say something.
Well, no, I was going to say, the one area that you touched on was rare earths, which I find has really been fascinating to watch. 10 years ago, it made a massive splash and sort of fizzled out. And that was largely driven by Chinese control of the market, the fact that all the refining capacity virtually was in China. Today, we're starting to see a rebirth of rare earths. We're seeing great valuations on some of these companies. And the thing I find interesting is, the Department of Defense here in the U.S. is funding refining capacity here in the U.S. There's talk of expanding Neomaterials facility in Estonia. You're talking about new projects in Europe. So I think there's, the UK is looking at a number of different refining projects there at the industrial parks. So you're seeing a real shift. And I guess one that so this is an area that I am going to watch closely and sort of see what's going to happen with this rare earth sector. The Chinese don't quite have the refining control that they did. And I think that may create some opportunities that we hadn't seen previously.
Yeah, interesting. And we haven't, and that's really kind of niche, isn't it? It's a very fragmented sector.
Mm-hmm. It is.
Not even like a mid-sized company really is present in any meaningful way. I don't think. Sorry.
Yeah. I mean, I think rare earths is interesting. I think the problem is it has that boom bust, nature to it, which is obviously a little more challenging when talking about investing. I think what I expect for the next, call it 2 years, is just a lot more project development rather than mergers and acquisitions. Those companies raising all this capital, taking assets through PEA, bringing assets through pre-fees, etc. I expect to see a lot more of that. It doesn't necessarily help those of us that are trying to put large sums of capital to work, because these tend to be smaller increments. But I think it does go some way towards restocking the pipeline, and hopefully we'll bring more projects into the more development stage so that there can be capital put to work in more meaningful amounts.
So a healthy hiatus in M&A, perhaps, and slowing down in M&A while the shelves get restocked.
I agree with Caroline on that in general. I wonder if the exception to that may be in gold, where you have no lack of projects, the price has been good for a period of time, so there's no restocking needed there. And secondly, and this is obviously a big if the spot price of gold were to settle somewhere approximating the long-term consensus pricing, that would be a situation where it allows people to make strategic decisions. The spot price doesn't become an disincentive or over-incentive, if you will, versus the long-term consensus. And of course, some of the better operated companies will actually finally be converting, and let's see how many of them actually do this, but will be converting those good prices into cash. And if they actually turned those good prices into cash, then there's two currencies there that can oil the wheels of M&A. So it's not a prediction by any stretch of the imagination, but the sorts of circumstances could be right for some gold consolidation.
Interesting. So in gold, perhaps, in other subsectors, perhaps less so, perhaps more focus on development of assets and bringing them on to an acquirable sort of status or a mergeable sort of status. Very interesting. I'd like to thank everybody very much for taking part today. I hope our audience appreciates the level of expertise and experience that they're getting here as ever from Minds and Money. I'm going to say thanks to everybody, and to the audience. I hope you enjoy the rest of the conference. Thank you very much.
Thanks, Graham. Thanks for organizing this.